Good morning, everyone. Welcome to the stream.
So we'll see if it comes to fruition.
Doesn't mean you get to a deal. Daniel Pinto?
No.
Did you get that from Daniel Pinto?
No, I don't speak to Daniel Pinto. You're referring to obviously J.P. Morgan and Mr. Pinto, who's
maybe you won't need to speak to him come May.
He's the president and chief operating officer. He will be relinquishing those responsibilities at the end of June, retiring from the firm at the end of 2026. He has frequently been referred to by Chairman and CEO Jamie Dimon as his sort of hit by the bus replacement, so to speak, a break the glass replacement.
Yeah.
But he is being replaced by Jennifer Pepsack. She'll be assuming the role of president and COO at J.P. Morgan. But she is not in the running, is the understanding that we have as well. And I think Leslie Picker was reporting on this for CEO. That according to a source that I think Leslie's got familiar with the matter. So interesting. Succession at J.P. Morgan. I mean, Jamie's in his late 60s. You know, my understanding based on casual conversation I have with people, of course, at the firm and the like, is their expectation is he's certainly going to be there till that building is done. An incredible, beautiful structure they have going up. It's up, but they got to finish it. It's going to be a little while in Midtown.
Do you go to Wells
Jim.
Fargo? Do you just go to Wells Fargo, which is where ex-officials of J.P. Morgan go in the end, right? He just goes to Wells.
Who goes there? Daniel
Charlie
Pinto?
Sharp?
No, I think he's just retiring, isn't he?
No, people who worked at other major banks, they tend to end up at Wells Fargo. Shouldn't we be talking about Eli Lilly? The stock's down a lot, and people are worried.
Well, you were just talking about it in the Mad Dash, and you told people not to worry.
Well, no, but I happen to have David Ricks here. I mean, it kind of works. See, he's the CEO. Boom.
I know.
What do you think?
There was one thing I wanted to get to. You want to get to it right now?
We can have him sit here forever.
I know. I don't want to let him sit there forever. Let me just quickly do this.
Go ahead.
Let me do the supply digital deal. It's APL. It's small, but it's perhaps indicative of a trend that we're going to see more of. Bitcoin miners to hyperscaler capacity. They're taking in.
Hold on, trading for today. I took pre-market trades, most of them, about 10 minutes before the market opened. But here what we might see for the day. So we have this bottoming tail here, and now we are green today. So let me see here. How do we? So we might actually go up and retest the 50-day moving average roughly at 21,225, let's just call it. And because you also have resistance over here, so that's going to be hard to push through that. So once you're below the moving averages, uh, it's usually bearish, right? But we put up this bottoming tail. So let's see what do. Let's go to weekly. I like these charts here because they're very accurate. Think of swim. So this makes sense. Getting a bounce off the 20-day moving average on a weekly chart. So we might come up and retest this resistance at roughly, 21,000 to 25, 250 or so. We can go even higher, just retest this moving average. So 400 or so, but I don't think that's going to be that strong. But anything can happen.
You said that it's going to be, I heard you say, somewhat the same. I mean, I'm trying to understand. The reason I point this out is, I was critical about the way you talked about the third quarter because I couldn't figure it out.
Right.
Fourth quarter, if I can't figure it out, at a certain point, I don't want episodic volatility from Eli Lilly.
Sure.
I'm used to Eli Lilly going like this, not Eli Lilly being an oscillator. When are we going to get numbers which just indicate this is a straight out ramp and I don't have to worry about the granularity?
Well, we've put our best effort into this latest projection. We're doing something others have never done, right? We're growing pharmaceutical product at a rate and a scale that really is new for us and new for the industry. We're going to get some things wrong, and we have. We saw destocking in the channel in the second half. We've put that into our forward outlook. We don't expect that to come back. We've seen ups and downs in various parts of the market, patients switching between the diabetes form and the obesity form. Prediction, has been tougher, but to be honest, the underlying fundamentals are incredible. The total GLP-1 market last year grew 45%. We grew 60%. And we grew share in the fourth quarter. In fact, Jim, we're now the market leader in both diabetes and obesity in new patient starts, crossing Novo. So we're in great position as we set up the year. And the other big issue has been manufacturing and supply. We said to the street we'd hit 50% growth in units in the second half of this year over the same period last. We hit that. Now we're saying for the first half of next year, first semester, 60% growth. So some of that supply is coming online. That's growth on top of growth. And we're excited about 25.
So what is the inventory level? Do you have enough to meet the demand? That's what I think.
We have plenty of inventory. We have about 4 weeks on hand at Lilly. What I think we're seeing now, what we didn't predict, one of the assumptions we got wrong is because there's been supply tightness in the first half of the year, inventory levels rose in the retail channel. They rose in the wholesale channel because of uncertainty. As we become a much more predictable supplier, people are just pulling that down on demand. They've been able to work down their working capital, and patients can get the medicine when they want. We finished the fourth quarter with every dose in stock and available the whole time. So we're in a good position on supply now, and I think the channel's just responding to that.
All right.
Could we have seen that? Yes.
Well, okay, so when is pill coming?
Yeah, so we get our first data. So next year, big tailwinds in the GLP-1 business for us. First, new indications, sleep apnea, heart failure, et cetera. New markets, Mexico, Brazil, China, and new forms. So oral GLP-1 or orforglipron, we'll get our first data set sometime late Q2. Excited to see that. That'll validate the profile, which we hope to be as good as semaglutide, but in a pill form. That will allow us to scale around the globe in really an incredible way.
Okay, now you mentioned heart failure. Let's not skip over this because what some people are worried about is payment. If it's hypertension, which is the silent killer, if it's actually sleep apnea, these are things that people pay for. The governments around the world will pay for. So I think that that's different from weight loss, which people sometimes feel is fanciful, even though you and I both know that obesity is another killer. So the idea that all these countries you just mentioned, plus the United States, will pay for it would make it so that I think that 2025 is a much more important year than 2024.
We're going to get there one way or the other. I think in time that health payers will pay for obesity and will recognize it's the ultimate prevention medication to prevent all kinds of chronic health diseases. In the meantime, we'll bite that off piece by piece. You mentioned sleep apnea. That's 14 million Americans, most of who are obese and can now get coverage. Medicare said they'll cover that. Heart failure, another one. There's so much overlap between these chronic conditions you know so well. and obesity. So we'll either get it through the new indications and the data that's proving using the medication to lose weight isn't just good, for in a general way, it's specifically addressing these diseases. Those will get reimbursed. But I think over time, eventually people will just realize, why don't we just pay for obesity medications? It's a disease and it helps people get healthier. They're probably going to live longer and avoid these chronic conditions to begin with, rather than wait till they get the condition, then pay for it.
All right, the elephant in the room for me is RFK Jr. When I saw him, I talked about diet and exercise versus injection. This is a man who does not favor vaccines. He believes diet and exercise are the holy grail. Now, you and I both know that diet and exercise is the reason why you need GLP-1, because it's a failed strategy. Yep. We all want it to be the right strategy because it's purity. But tell the truth, diet and exercise strategy has failed our country and the world.
Well, up until we launched our drugs, it was the standard of care, and it wasn't a very good one. We studied our drugs against it, so we know in big populations where people are already overweight or obese, on average, they lost about 2% of their body weight over a year and a half. So I don't think that's that impressive. And we put people on a rigorous diet and exercise program. But on the drug arm, people also pursue diet and exercise, and it's a foundation of obesity management. But with the medication, once you become obese or overweight, the results are profound, losing 22% of your body weight on our drug versus 2% on diet and exercise. Where we agree with what Kennedy is saying and now the incoming president is we can do a much better job keeping people healthier early in life. Food system, we can improve, movement, exercise, all good. We support that fully. Right. Our company wakes up every day trying to make America healthy. But when people are sick, they need medicine. And obesity is a sickness, and that people with obesity need medicine.
Okay, so let's dream for a second. Joints, maybe cancer, maybe dementia, all within reach for your drug?
For GLP-1? Yeah.
Yes.
So I'm really optimistic, of course, about the metabolic syndrome stuff, which is already in the pipeline and studies rolling out. The next phase that we're looking at are inflammation. Mm-hmm. So with our next generation triple acting incretins, so remember semaglutide single acting, tirzepatide dual acting, retatrutide triple acting, so it'll be even more potent and strong. We're looking at knee pain, back pain in our core programs. And I think that's an inflammation-driven process.
When will you come up with something that makes it so you don't lose muscle equally to fat?
Yeah, so right now that story is cloudy, but the bottom line is...
No, man, you got to make that not cloudy.
Hear me out, Jim. Okay. When you lose weight by any means, you lose fat and muscle, whether it's on drug or not. And that's a natural process because you're carrying less weight around, right? So if we had you carry 20 pounds around for a year, you'd be more muscular, right? So that is a physiologic fact. Older people, we worry about this a little more because they're not moving as much. So we do have a phase 2 program now called bimagrumab, an acquisition we made last year, which we're going to study with on top of tirzepatide, which helps you lose a little bit more weight and build muscle. That study's going to read out maybe late this year, early next year. That could go into phase 3 and be a great solution, particularly for those people that are older. For everyone else, I think eating protein, exercising, a fitness regimen on top of weight loss medications makes great sense and tends to work.
Okay, now in terms of the new administration, IRA, I hate to say Inflation Reduction Act because it was Inflation Increase Act. I do not believe that President-elect Trump would have the same kind of relation that President Biden had. I think he will speak to you. Mm-hmm. I think you will be able to... Already has.
Yeah. Albert Bourla and I met with him in December. Yeah.
Okay. Well, then, I mean, to me, that there will be not a conviviality because people are always concerned about the price of drugs, but there'll be give and take. There'll be negotiation. Do you think that's correct?
Well, we'll have to see what he does with the Inflation Reduction Act. I think one thing we agree on is what really matters isn't the price of the medicines in the channel, but what people pay when they go to the pharmacy. Right. And in the first Trump administration, Lilly worked with his team to lower the price of insulin to $35. And that was enacted in law by Biden. Great. That's how government should work.
He did that voluntarily.
We could do more in that regard and lower the out-of-pocket costs. That will have a bigger impact on the health status of Americans, the image of our industry, and, frankly, the respect people have for the health benefit they're getting from the government than anything we can think of. So we'd like to do more with Dr. Oz and the team coming into HHS.
All right. So one last question. People are concerned the stock's going down. Why would you spend $20 billion in manufacturing if you felt that maybe this was not going to be the biggest drug of all time?
Yeah, I mean, I don't understand that logic, if people questioning that. If we look at, again, we exit the year, we're growing over 60%. We're annualizing at 25.
Do
We've
people
got an
understand
incredible
that that's
outlook.
unheard of?
Yeah, never seen before in our industry. And we're just getting started. As you said, we've got new indications, new modalities, new markets. All these are tailwinds on the growth picture over the next couple of years. It's an incredible time in this space. And by the way, Jim, we have a whole nother business in oncology,
I know, I'm
in
sorry.
immunology,
Scorpion is good.
in neuroscience. And that's a $20 billion business as we exit the year, growing in the mid-teens. That would be the number one pharmaceutical company in growth, if not for GLP-1s. So we're running a great business with two parts to it here, and excited about both sides.
And lots of cash spewing so you can make acquisitions if you want.
Acquisitions. We announced a big share buyback program in December and an increase in the dividend again. We feel good about where we are.
David, congratulations. I think there's a lot of misinformation about what you intend to do and how the moat that you have and how important these drugs are, but it doesn't matter. Short term, let people sell it. That's my job, I know, not yours. But long term, you're crushing it.
We're focused on inventing new medicines and long-term growth of the company, and I think on those marks, we're doing incredibly well.
Thank you very much, David Ricks, Chairman and CEO of Eli Lilly. Back to you, Carl.
Jim, our thanks to you. We'll get some thoughts about that interview in a few minutes. Meantime, Bulls working on this bounce here in the wake of the cool PPI. Bonds a little bit lower on the short end, although the 10-year still stuck around 4.8. NASDAQ's up 0.6, Palantir up 4, Tesla up 3. Best day for home builders since November. Don't go anywhere.
NBC.
Let's get to Jim and stop trading.
Yeah, Honeywell doing what Elliott Partners wants, which is to split automation and aero. People thought this would be a great idea. Whatever Honeywell seems to do is disappointing. A lot of that is because of the earnings, which have not been up to snuff. I think that this is an opportunity. The stock is down 5% for the year, even though they're doing something that could be very much like what GE did when they split into energy, healthcare, and then core aerospace. I think the stock is a buy, but people want to see the quarter, which they think will be a disappointment, and they want to sell ahead of that. I say let them do it. The parts are worth more than the whole.
Jim, I'm not sure the street was took some solace in your interview with Ricks. Lilly down 8.
Oh, look, I think the problem with Eli Lilly is, as David Ricks admitted, is there have been some mistakes. They have not done the launch as easily as people thought. I say, as I said at the beginning, let them sell it. I mean, in the end, this is the GLP-1's greatest drug of all time. It will be used for multiple indications. People wanted David Ricks to come out here and say, you know what, next year's going to be far bigger than expected. He doesn't play that game. It has never been the way he does things. We sold some stock when it was in the 800, 900 from a charitable trust. All I can say is now I'm restricted. I can't buy it back right now. I wish I could. Down 8%. I think it goes down 10% as we get rid of people who don't understand the story, and then people come in who understand the story and they'll buy the stock.
All right. How about tonight, Jim?
Okay, I've got a host of people. You know, I want to do. I'll be doing Regeneron, which is another stock that seems to have disappointed people. Bizarre. Merck, which is down very badly, even though they've got Keytruda and a drug that's going to be very much life-saving. Abbott, not understood very well because they're doing tremendous stuff when it comes to diabetes. People don't seem to care. And Cardinal Health up. Why? Very simply, because Cardinal Health is a middleman. People didn't want to own it. Turned out to be better than expected. I would absolutely do the opposite of everything I just said in terms of where stocks are going. Everything. Take the other side of every one of those trades.
That's a lineup.
Take the other
Look
side.
forward to going over the banks with you in the morning as well, Jim. We'll see you tonight. Mad Money, 6 p.m. Eastern Time.
Oh, yeah, definitely. Thank you.
When we come back, Lululemon's Calvin McDonald with the Dow up 75.
Here are my fills. So I took pre-market trades. So this green bar, very strong. Got to pull back to the moving averages. And there you have it. Then I took another trade here.
CNBC.
Good Tuesday morning. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with David Faber here at Post 9 of the New York Stock Exchange. Sarah Eisen's going to join us later this hour from the NRF Big Show, along with an interview with Lululemon CEO Calvin McDonald. Meantime, bulls trying to hang on to these opening gains in the wake of this cool PPI number. Of course, CPI joins us tomorrow. 10 years still a bit elevated, down just a touch around 4.79. Three big movers we're watching. Signet getting crushed after the retailer cut its sales guidance. KB Home surging after Q4 results did top estimates and deliveries rose 17%. And United Rentals, a top gainer, acquiring smaller rival H&E Equipment Services in a roughly $5 billion deal.
All right, we got some inflation data this morning, and it did come in cooler than expected. That has sparked a bit of a rally in the equity market, as you see. Not too much, but a bit. Let's get to our Steve Leisman. He's got a closer look at the underlying numbers of PPI. Steve.
Hey, David. Yeah, finally some good news on inflation. The PPI, the producer price index, coming in better than expected, raising some hopes that the worst may be avoided in tomorrow's consumer price index report, which is the more important of the two. Headline coming in 0.2 versus 0.4 last month, and an expectation or an estimate of 0.4. The core flat 0.0. Goose egg versus 0.2. Takeout, food, energy, and trade, it actually fell 0.1%. But the headline still showing some in the pipeline, 3.3 versus 3.5. Looking at the details, food declining after massive increases last month. Some of them related to the avian flu. Other issues were out there, but they were down this month. Energy, though, popping higher. Trade down 0.1%. That's the measure of margins out there among wholesalers and retailers. One concern is the domestic air travel prices rising 6.8%. on the month. Some of that could carry over into the CPI. But good news there, services, another goose egg. On commentary nationwide, senior economist Ben Ayers writes, this tempers the higher end of expectations for tomorrow's CPI report and clears the way for softer inflation readings in early 2025. That's one of the expectations out there, that we don't get the big numbers in January and February that we got last year. Probabilities, well, June, 55% for just one cut. That's the first time it gets over 50% is in June. And December, well, we really can't price in that second cut. It's just a 32% probability. Well, Kansas City Fed President Jeff Schmidt adds to that concern about a second cut, repeating comments he made last week. He believes we're at a point where the Fed doesn't need to be restrictive on the funds rate or supportive on the funds rate. Policy should be neutral, and it's just about where it ought to be right now. Guys?
Steve, you mentioned airfares. Pantheon today, biggest December rise in PPI for air travel since records began in 2001. I see some core PCE projections getting lifted a bit on that, as you said.
Well, that would lift it, and it would be an area of concern. I mean, if you heard what Delta was saying, if you read also the hotel rates apparently are higher. People are traveling. It's one of the reasons why it's hard to say, Carl, this economy is not doing well, because, you know, a lot of that travel, it's a completely discretionary thing that people do. So it's hard to say we're in a bad place right now when people are traveling, but they've kept their capacity down. If I sound a little angry at the airlines, it's because I am. The planes are very crowded. They're filling them up, and they're charging you top dollar to go. So that is a good sign, but it's going to feed into the inflation report tomorrow. But as you know, Carl, the big story is the PCE. I'm seeing estimates between 0.2 and 0.3. Again, not something that's going to get the Fed to cut, but at least they might be on hold while this works through the system.
Steve, a couple important days that we're in the middle of talking a bit. Steve Leisman on PPI this morning. Let's get to the broader markets as well. Following that print, Brian Belsky joins us this morning. BMO Capital Markets Chief Investment Strategist joins us. His target for year-end, 6,700. Brian, great to see you. To what degree are any of these inflation prints a concern for you right now?
No concern, Carl. Good morning, everybody. Happy New Year. You know, we continue to think that investors are way too focused on the two M's, that being momentum and macro. I think we've entered the golden age of stock picking. We've been saying this for a while. We think so many investors remain so focused on the Fed funds futures now. You have strategists out there saying the Fed's not going to cut it all this year. I think we need to all settle down and just let stocks do their work. I mean, what we're in is an environment, quite frankly, that normalization has begun. We've been talking about it for 2 years, that we're entering into this period, Carl, where we have high single-digit, low double-digit performance, high single-digit, low double-digit earnings growth, a trading range for the 10-year Treasury, which is exactly what's occurring. We're so focused, man, on this 5% number, 4.8% number. How about like a range of 100 basis points, which is pretty normal over the last 70 years in terms of the 10-year Treasury? And then lastly, in terms of valuation in general is at the higher end. We know that. But if you take a look at a high teens, low 20s multiple over the last 30 years, that's actually quite normal, especially given the growth environment. So I think everybody needs to focus less on momentum, less on macro, and more on bottoms up stock picks.
So wait, Brian, 22 times, isn't that roughly where we are? That's more normal than we might otherwise think. Feels
yeah, it's more
high.
normal. Well, no, I mean, again, David, good morning, by the way. If you take a look at the last 50 to 70 years, it actually is quite normal. Especially if you take out some of the other extreme areas, like if you take out the 90s, which you and I lived through, or you take out the 50s, 40s, and 50s. And so, you have to take a look at things from a longer term perspective. By the way, BMO has learned that the markets actually were around before 2008. BMO has learned that the markets have been around before 2020. We seem to have this very, very short-term focus on the market. And all we remember is actually what happened yesterday. I think this is time for perspective. It's time for kind of longer-term holding periods in terms of stocks. And I think we're very blessed because we have the opportunity to run money for BMO Wealth Management on the side from our institutional exposure. And we had amazing performance last year. Why? Because we held on to our stock picks and we held to our guns.
Are you worried much about this school of thought that looks at negative equity risk premium, where you're getting more for treasuries than you are on S&P earnings for the long-term return of equities?
I am, Carl, and it's a wonderful point because I do think from an equity risk premium, the stocks don't look as expensive, let's say, as most people think, number one. Number two, I do believe that over the next 10 years, the majority of returns from fixed incomes actually be coming from yield. If you take two steps back and look at the bond market, the last 40 years, the majority of returns from the bond market have come from price performance, not yield. I believe that in this stock picking environment where you have high single digit, low double digit performance, in the midst of this 25-year secular bull market that we've been talking about since 2010, bonds in a 60-40 environment, actually from an asset allocation basis, make a lot of sense. Bottom line, you still want to be in U.S. assets, whether or not they're stocks, especially a broadly distributed stock market, large, mid, and small growth and value, but also shorter-term treasuries with respect to the 10-year.
That multiple gets pushed higher as a result of obviously a handful of stocks that trade at much higher multiples, being the mega caps largely, Brian. Now, they may deserve it because they have higher growth rates, but I'm curious as to how you sort of view that bifurcation that we've been talking about now for years.
Yeah, it's a great point. And I think, number one, you get what you pay for, especially given the technology earnings. We've been saying for 10 years that the big cap technology companies, the ones that you're on screen right now, are really the new consumer staples. I'm not saying this is a rational exuberance like Greenspan warned about in 1997, 98. What we're saying for tech is own these as your core holdings and then own the barbell on the side of owning smaller cap tech, let's call it Palantir and Oracle and AMD. With respect to the overall market, though, we think earnings projections are too low, principally because one of the biggest parts of the market, David, financials, really since the credit crisis, have been massively underappreciated, massively underanalyzed, quite frankly, analyzed by a bunch of analysts that are still very, very, very negative. And we think from a bottoms-up basis, financials are going to be the quote-unquote pick to click as earnings are way too low, analysts are way too negative, and we see the massive deregulation, which we think is going to happen in the next few years, really be a huge tailwind that nobody's talking about.
We're going to get a lot more information on that front in the morning, Brian. I'm sure we'll talk in the coming days. Thanks for kicking off the hour. Good to see you, Brian Belsky.
Thanks so much.
All right, let's get the latest on the California fires. NBC News correspondent Steve Patterson is live from the Porter Ranch neighborhood in Los Angeles, where we can see the winds are certainly pretty strong, Steve.
And that's why we're here, David. We're hearing about a particularly dangerous situation. That is the official designation from the National Weather Service. It's meant to be a particular elevation from the normal red flag winds that we normally have on the ground. It's even worse than that. The last 3 times we've had this designation, it has led to serious property damage, including some of the worst fires in California history, in the history of this country. Meanwhile, there's great worry that as this goes down to lower elevations, and we're already seeing wind gusts 60, 70 miles an hour in some of the canyons and mountaintops. As this comes down, it could start new fires. In fact, overnight, firefighters doing their best to battle some of those brush fires that we've seen sort of in the area. But the real worry is that the major fires that we've had, the Palisades fire, now 14% contained, the Eaton fire, now 33% contained. If this wind picks up a pocket of embers, it could easily move the front of the fire to somewhere new, causing a whole lot more of a mess here. There's also the possibility of electric shutdowns for several thousand customers in the area if the winds get too severe. They want to limit the fire danger, but we are in severe fire danger right now. The National Weather Service calling it as bad as it gets. Meanwhile, the investigation into the fires continues. The ATF looking at the Palisades fire as the possibility of what they're describing as a human start, but still very early on. Right now, they're keeping those scenes locked down from people who are looking to just pick up the pieces of their lives. But with this wind event and how particularly dangerous it is, those zones are still off limits as investigators and firefighters continue to do their work. Carl, I'll send it back to you.
A difficult calculus right now for businesses, too, as they try to resume work, aware of all the risks in the coming days. Steve Patterson out west, thank you. As we go to break, take a look at the roadmap for the rest of the hour. It's been a volatile start to the year for NVIDIA, as you know, and the semis rallying, then giving up some gains. What the latest action from the White House means for the group.
Plus, the big banks are gearing up to report earnings. That'll begin tomorrow. We're going to get you ready for that.
And Sarah's live at the big retail conference in New York with the CEO of Lululemon. Squawk on the Street is back after this short break.
been a volatile start to the year for NVIDIA overall, the semiconductor sector as well. Today, President Biden issued a new executive order to speed up the construction of AI centers and strengthen national security. This is just one day after announcing a new framework that would limit the scale of AI chips and their sale outside of the U.S. Joining us now is Bernstein analyst Stacey Raskin. Stacey, always good to have you. What do you make of these newest regulations and the impact perhaps on some of the companies you cover, in particular NVIDIA?
Yeah, it's a little hard to judge impact right now, but we can talk about like what they're doing. So they're putting constraints on the amount of compute capacity that can be shipped out of the US to a certain number of countries. There's 18 countries where they're sort of like favored nation status, kind of business as usual. Customers in those countries can pretty much build as much as they want in those countries. There's a set of countries, China and Russia and other ones that are under like arms embargo where you're not allowed to ship anything. None of those things are really any change. It's in the middle, the other countries where the interesting sort of dynamics happen. Those countries have very sharp limits on how much compute capacity can get put in them. Unless the customers themselves sort of agree to conform to certain standards, basically, be good citizens and the like. And if that's the case, then those customers can build in those countries, but those customers will be limited by how much compute capacity they can deploy. So if you kind of run through it, it's probably manageable for now. But my guess would be as we go along over the next years, these constraints in general are probably unlikely to loosen, right? We're sort of in an arms race with some other actors in the world. And, these constraints in general are likely to tighten up. And in general, that sort of thing it's not great, right? I think right now the overall demand for this stuff is such that this can probably be worked through. And like I said, it does seem like it's workable, but it remains to be seen how these dynamics will play out as we go forward and whether and how these different kinds of constraints continue to get tightened. And now we have the new administration coming in, which throws a whole new.
I know that career, right? I mean, well, are your expectations they're going to maintain the rules that have been put in place?
Yeah, I don't. The companies that have been impacted, NVIDIA and some others, have sort of been going at the new administration to try to to advocate for themselves. And I got to be honest, I kind of understand why the Biden administration did this, but at the same time, doing it a week before the the administration change, it feels a little shaky. So we'll see what the Trump administration does. But I want to say I'm not sure that the incoming administration. I mean, in general, this idea that we need to be tough on these other areas and we need to be U.S. first. I mean, these are things that I think the new administration is going to want. So I don't know whether or not they will be pulling these. There's some aspect to this that maybe they're not going to like, but my guess is in general over time the sanctions probably never get looser. In general, they'll probably continue to get tighter.
How do you explain to folks why you think the administration did this?
Well, I mean, it's their last chance to do something like this. And again, the general idea, like trying to control what's out there from a national security standpoint, I understand the rationale. I'm not sure I necessarily totally agree with it, but I understand it. This is their last chance to do it. And again, they're going to force the new administration, if they want to do something about it, to do something about it. But they put a stake in the ground one way or the other with 1 week to go.
Stacey, today's highest performance chips are tomorrow's lower performance chips. I mean, how does that end up working? Is it always just that we want to stay ahead, so one day they'll be able to get these chips, or not?
Yeah, I mean, like I said, I think when you go through the regulations from yesterday, and we did it, it's preliminary, but when you read through it, as they're written, like I said, it doesn't seem like it's draconian as people. I think when some of the news stories on this came out last week, people were really, really worried that they wouldn't be able to ship anything, or that the amount that they would be able to ship in general would be very, very curtailed. If you look at the favored nation countries, they're the major ones where a lot of this is going, and the U.S. guys can build as much as they need here in the U.S. and they have leeway to build outside of the U.S. to a fairly large degree. So when you sort of read through it, they weren't necessarily as draconian. They were fairly severe. Don't get me wrong. I was a little surprised when the news flow started to come up, but they weren't as completely draconian as maybe people had feared they might have been. And so, but this sort of stuff destroys volatility. And let's be honest. When the new administration comes in, it's going to be volatility every day. I've said this before, but when Trump was president last time, I'm spending every morning waking up. The first thing I do is check Twitter to see what the policy of the day is. So we'll probably be going back to some of that. Volatility in general is going to be higher.
Yeah, we'll be doing the same thing you are. Although
Yeah.
I think it's Truth Social these days, not
Truth
X.
Social.
Yeah. Stacey, thanks. Appreciate it.
Yeah, you bet.
Meantime, the financials have come full circle since their post-election rally. As you know, a lot of the big banks report earnings in the morning. We'll talk about what investors need to know going into those results in a moment.
Yükselen ben değilim bak asansör. Şayet beni uçak.
This is what it's like chasing profits. Two hound dogs chasing a rabbit.
NBC.
Just a day away from the big banks kicking off the earnings season. J.P. Morgan, Goldman, Citi, and Wells set to report. Our Leslie Picker is raising the curtain on that, along with some news on J.P. Morgan this morning. Hey, Leslie.
Hey, Carl. Yeah, busy morning and busy week indeed. Bank stocks, though, they've really come full circle from their post-election glow, where the prospect of deregulation sent the sector soaring. And even as gravity has taken hold in recent weeks, looser capital requirements and what they mean for buybacks remain an open question. Goldman Sachs estimates there's about $185 billion in excess capital, some of which could be returned to shareholders if banks were required to hold less of a buffer against a shock. Over the last year plus, banks have been hoarding capital despite a stronger economy due to the expected hike from the proposed Basel III rules. Now, under the new administration and with pending turnover in the Fed supervisory role, it's highly likely that the new rules will be far less onerous. So as a result, Goldman says the industry could repurchase about 4.5% of its market cap in 2025. The firm estimates banks will have $90 billion in excess capital if Basel III were to be just 50% as tough as originally proposed, and says J.P. Morgan, PNC, and U.S. Bank have the highest capacity for that capital return. Now, any buyback revelations will be key as banks such as J.P. Morgan, Wells Fargo, Citigroup, and Goldman kick off earnings season tomorrow, guys.
Leslie, love to get your thoughts. I referenced your reporting earlier as well on Pinto stepping down, being replaced. And then there's Petno, which we can get to as well.
Yes. Daniel Pinto, Doug Petno is taking on that role as co-CEO of the Commercial and Investment Bank. He is taking the place of Jen Piepszak, who is moving up into the COO role as Daniel Pinto steps down. So a bit of a management shuffle there. And anytime you see a management shuffle of this nature at JP Morgan, the question everybody wants to know is, what does this mean for succession? What does this mean for Jamie Dimon's timeline as CEO of the firm? In talking with sources, I'm told that the timeline for him hasn't really shifted, that it's I think he said in April or May of last year, the timeline is going to be less than 5 years, essentially. So we could maybe say 4.5 years. Within 4.5 years, he may step down as CEO. But importantly, Jen Piepszak was seen as a key contender for that top spot. And I am told that she had reached out and kind of made it clear that she would rather have that operating role, that president and COO role, perhaps than the top CEO role at this time, which leaves a cast of essentially three main candidates for that top CEO role, which are the three business leaders that you mentioned: Doug Petno, who is now succeeding Piepszak as co-CEO of the investment bank, and then his co-head, Troy Rohrbaugh, as well as Marianne Lake, who runs their consumer business. David.
As for Goldman, Leslie, it's also this week, a couple of pieces of news on the tape this week. One's about sort of banker bonuses. Season's going to be pretty good as some of these fees are on the rise. And then this journal piece yesterday on this big financing push in this so-called Capital Solutions Group.
Yeah, which makes a lot of sense that they would put everything under kind of one roof there, because financing solutions, a lot of their peers, by the way, in the alternative space kind of do it that way under that solutions nomenclature, where they'll offer any type of solution that the customer wants. It's essentially like a grocery store for lending. So it would make sense that they would structure it this way. They've done a bit of, rethinking under David Solomon for how best to, bring together individual businesses based on what their clients want.
Leslie, thanks. Earnings get started very soon. All right, Leslie Picker. After the break, we're going to have Lululemon CEO Calvin McDonald. He'll join Sarah Eisen. Of course, the company raised its fourth quarter earnings and revenue guidance this week. That'll be certainly part of the conversation. We'll be right back.
What's up, Bulls? You trading this morning?
orhers.com.
Welcome back. I'm Seema Modi with your CNBC News update. President-elect Trump's controversial pick for defense secretary is testifying right now in his Senate confirmation hearing. Pete Hegseth, who is a combat veteran and former Fox News host, facing questions over his limited management experience and allegations of sexual misconduct and excessive drinking. He's also expected to be asked policy questions, including his comments that women should not serve in combat roles. Special counsel Jack Smith releasing his report overnight, laying out his decision to charge President-elect Trump with trying to overturn the 2020 election results. Smith wrote a jury would have convicted Trump and said he would made false claims of election fraud and inspired his supporters to commit violence on January 6th. Trump called Smith's findings fake. And a new Pew Research Center study finds nearly half of remote workers in the U.S. say they would quit their jobs if their employer made them come into the office. According to the survey, women, workers younger than 50, and those who are fully remote were more likely to say they'd leave. Carl, I'll send it back to you.
Interesting, Sarah. Seema, thank you very much, Seema Modi. About an hour into trading here. Dow and the S&P holding on to some moderate gains in the wake of these inflation numbers, which we continue to chop through this week. That said, Goldman Sachs CEO David Solomon is warning the battle isn't over. Take a listen to his remarks at the NRF's Big Show conference. This is just over an hour ago.
I think, we're in a more fragile place. I'm quite optimistic, but we're in a more fragile place. There's no question that, inflation has taken a toll and it's affected, average consumers meaningfully. Inflation is cumulative and things are more expensive. When you look at inflation, there's no question with respect to goods, we've made progress, and especially durable goods, but services, inflation is still quite high.
Let's get to Sarah Eisen, who is live at NRF this morning with a special guest. Morning, Sarah.
Good morning, Carl. Yes, I am here with Calvin McDonald, the CEO of Lululemon. We just did an on-stage fireside chat, and now we have him here for CNBC. It's nice to have you.
Great to be here.
And fresh off of some big news, you guys just raised guidance for the fourth quarter, the holiday quarter. What did you see over that shopping period from consumers?
Yeah, we saw success and momentum in all of our markets around the world. Across both men's and women's, really across our categories. And similar to what I've been sharing, the guests responded well to our innovation and our newness, which we continue to get back to historical levels, which we will be come Q1 of 25. So a good full price business strength. We're going to come in below where we had guided to in markdowns, drove the business through innovation, full price, and really in every market we're in.
Which is why you raised sales and profitability.
And margin.
Question is how much of it was in the U.S. and whether you're seeing any kind of resurgence there, because that's been the pushback on the stock and the performance.
Yeah, we've talked about our opportunity in the U.S., particularly really U.S. women's. Our U.S. men's business has continued to perform well. We know what our opportunity is. It was some product decisions we made versus the consumer or the market space. We had more newness. She responded well to that. So we are pleased with the results across every market, and then obviously very focused on Q1 of 25. But we're pleased with our results in every market and saw a good adoption of our product.
But specifically in the U.S., so you've been talking a lot about newness and also expansion of sizing in terms of opportunities. What are we actually going to see in the store that's going to drive the growth back in this part of the world?
Yeah, the sizing was more about depth of in-stock as we saw the size curve shift and change. We're in a much better position there. So you'll just have depth of availability in stores would be the shift that I'd say the consumer will see. We haven't dramatically changed our size profile in stores. What we are going to continue to see is the newness in the innovation, getting back to the more historical levels that we've carried week to week in our stores. And that really, we hit that mark in Q1 of 25. We progressively have been getting better through 24, and we've seen each quarter the results of that and the way the guests has responded. And Q1 is when we sort of hit that level, and we're excited about that.
So the stock is down almost 3%. It barely moved yesterday on the guidance hike, and it's underperformed in the last year or so, down more than 15, 16%. What do you think investors are missing?
I think the stock price is a reflection of the U.S. business. We've been very clear about what our missed opportunity was, and that's the work that the team's been in, and we've shared our short-term plan based on agility to get at those opportunities and what we're doing 25 and beyond. So we're very focused on what we control, which is the performance side of the business, and I believe we're doing that. I think it's showing in the results. I think it's supporting our narrative, which is that guests are there. They're looking to convert, and we just need to bring the product back to the historical levels, and that will continue to drive our U.S. business. And doing so, the share price, we believe, will continue to move in an upward. It's moved nice since the lows of 24 back in the summertime, and I think it's just supporting through performance. And I think Q4 supports what we've said, and will continue to drive that.
Is any of it competition from Alo Yoga or Viore or even some of the footwear brands that have done so well, like a Hoka or On? Is any of that cutting into the U.S. business?
For us, it's not. We grew share in the premium athletic market in Q3. So we know what the opportunity is, and it really is our missed opportunity in servicing and delighting the guest. There's a lot of share in large incumbents still that we're acquiring and for others to acquire. And we've never had 100% of our guests' wardrobe. So I think there's always opportunity for others to see success. And that doesn't mean it's coming at the expense of our business or our guest. So we're really focused on servicing the guest the way which we do. And we believe our product and brand is still differentiated in the marketplace. And we offer a balance of high performance, high style that others aren't offering the guest. And we just need to deliver the newness that she expects.
What about China? How is that market going? It's been strong, more than 20% growth a quarter, but some challenges on the macro side with spending and consumer confidence. So what do you see?
We continue Q3, our results in mainland China, our business was up 39%. China played into our raise of guidance, so we're pleased with our performance in that market and through Q4 as well. So we're early in all of our markets. We're early in mainland China. We have opportunities still in store growth and our digital and our product innovation and expansion, and really pleased with the momentum. So we continue to monitor the macro, but at this point have not seen a material impact on our business, and pleased with the continued growth.
You had a big announcement recently, this week, I think, that you signed Tiafo as a brand ambassador. We're not really used to seeing sort of big sponsorship brand deals from Lululemon, more Nike, Adidas, and maybe that's one reason why you're more profitable. Are you changing the strategy here? Are we going to see more marketing spend like that?
Yeah, we're definitely have been investing in brand building and marketing. I mean, we've talked about unaided awareness in every market as being a big opportunity to continue to drive our business. So we're going to continue to make those investments. Our men's awareness is quite low. And one thing we do know is that he responds well to male athletes wearing particular brands. So we're excited about these relationships. We're not going to be a brand that does hundreds and thousands of these type of relationships. We're very selective of who we want to be in relationship with. I'd say there's shared values. And the athletes we have, we're excited about. We're super excited to welcome Tiafo into the brand. He won his first match. But we're just excited with the relationships. And tennis and golf in particular for us are the two sports where we've added a few new ambassadors over the last year or two. And these are activities where they get to perform and wear our gear, and we think it's a great way to build awareness to the brand.
Finally, Calvin, retail executives, you're facing the question on tariffs. How much exposure do you have for production in China and the rest of the world if we do start to see these tariffs rise as we expect under President Trump?
3% of our finished goods are produced in mainland China, 0.3% in Mexico, and 0% in Canada. And if they go broader than that, obviously, like many others, we'll have a greater degree of impact, and we'll have to make adjustments both internally as well as guest-facing pricing.
Rest of Asia,
yeah,
where it's mostly produced, but overall manageable?
Manageable if it's targeted to those regions. If it goes broader than that, then it will be an impact, and we'll have to look at a variety of factors as well as pricing to offset.
Consumer will pay more. All right, Calvin, thank you. We got through a lot there. Appreciate the time today here at NRF, and it's always good to see you.
Thanks, Sarah.
Calvin McDonald, CEO of Lululemon. David.
Okay, thank you, Sarah. And still to come right here, we're going to continue to monitor TikTok's future. We're now less than a week away from a potential ban in the United States. We'll be right back.
AI is now.
The single worst performing sector in the entire S&P over the last 12 months has been, yes, healthcare. And while 2025 is still very early on, the sector has managed to outperform and be positive for the year so far. Now, with the big JP Morgan Healthcare Conference wrapping up this week, one chart watcher will lay out which stocks could be poised for breakout performances. Tune into our Market Navigator segment later on today on Power Lunch to find out which ones they are, 2 p.m.
For what's ahead.
The clock is ticking on a ban on TikTok. Bloomberg now reporting that TikTok is considering selling the U.S. business to Elon Musk. TikTok has responded by saying the report is pure fiction, in their words, and they cannot be expected to comment on it. Joining us this morning to talk about it, though, former National Security Council Senior Director Peter Harrell's with us. Peter, it's good to see you. This has gotten a fair amount of pushback. I wonder, in theory, if things click for you in your mind on this one.
I mean, I think this is something we're seeing the Chinese side float as a trial balloon. I've not gotten any evidence that Mr. Musk has been putting this forward. That said, there are obviously a couple other American firms that have expressed interest in buying TikTok, or at least the U.S. operations of TikTok. Don't think that's going to happen in the next week, but under the law, if it happens after the ban comes into force, the ban would then fall off.
What's been your general view of this entire saga? This goes back years.
It really has been quite the saga. President Trump tried to ban it at the end of his first term. Biden kind of debated it for a long time. Then Congress got involved. Look, I served on the National Security Council for a couple of years. I think the security risks around foreign ownership at TikTok are real. And I think a sale that rewards shareholders and makes sure that this is hugely important media asset is under U.S. ownership is an appropriate outcome here. The other thing I keep in mind is that while we think of TikTok and this whole issue around foreign control of media is new, it's actually not. If you look back at history, the U.S. has long been worried about foreigners owning radio stations and TV stations. Maybe you shouldn't talk about this on CNBC, but if you look at one of your competitors, the reason Rupert Murdoch became a U.S. citizen is because he wanted to buy Fox News back in the 1980s, and he had to be a U.S. citizen then to do it. And so this isn't really a new issue. It's just a kind of new application of a very old issue that we've had to grapple with.
The Chinese, and my understanding from ByteDance is it's been made clear to them at this point, have no interest in allowing ByteDance to sell TikTok. So we are kind of faced with the real possibility of it being shut down, so to speak. Now, perhaps that'll change, as you pointed out, after some time if it's been shut down in the U.S. But, they say they have some other plans. I'm not quite sure what they are. What are your expectations here in terms of what happens to this platform if and when it is actually shut down?
Yeah, so the ban's coming into force on Sunday, and I think that what you'll see on Sunday if you pull the app up on your phone, you'll probably get a notice on the app saying it's not available in the U.S. That is what happens in India. That is what happens in India, which banned TikTok back in 2020. That's not necessarily true. TikTok could choose to keep the app live. The law itself actually just prohibits kind of new downloads and updates and things. So it's possible that if you already have it on your phone, it might kind of simply exist and degrade over time, though I bet we'll see an India-like outcome where they'll actually turn it off. What can TikTok do here? What can ByteDance do? Well, one thing it can do is it can sell. I actually discount a lot of the statements to date. I mean, TikTok kind of had to say, we won't be sold because they were challenging the law in court because they don't want to encourage lowball offers. So they kind of had to say that they didn't want to sell. I'm not sure that's going to be the case after Sunday when their choice is either destruction, all this value, or a sale. So I think they may revisit that. There are obviously a couple of consortiums out there, including one called Project Liberty and a couple of others that are putting together bids for this. So I think we may see a sale. I think if we don't see a sale, what you're going to see is user migration to other competing apps. Under the law, one final point, because I know there's been some press on this. Under the law, actually, the ban would apply to any other ByteDance owned apps as well. So it's not that ByteDance really has an option of setting up, TokTik or some other new app and migrating users over there.
I think there's a hope, that what the Supreme Court will decide is not to overturn the ban, but at least to punt it to the Trump administration, sort of issue an administrative delay. And then the Trump administration, as you know, President-elect Trump has changed his position. He's now potentially in favor of keeping TikTok. The Trump administration then would be in a position to interpret the law to the extent that you're familiar with exactly what the law says. Is there a lot of interpretation that could allow for some flexibility here?
Yeah, so I reread the law just to make sure I was fully up to speed on it this morning. The first thing I would say is even if the Supreme Court doesn't extend the deadline beyond Sunday, and I saw the oral arguments, listened to the oral arguments, I would be surprised if the Supreme Court extends the deadline. But under the law, even if the ban comes into force, if there is a divestment after the ban, if there was a divestment a week from tomorrow, TikTok would then be available again. So, you'd have 2 or 3 days where it was banned and then it would become available again. So whether or not the Supreme Court extends the deadline, there's still going to be opportunities for the Trump administration to weigh in on this. The law is drafted to try to limit that discretion. The president's going to have to sort of avoid the ban. The president would have to certify that there had been a qualified divestment. And there are a couple of criteria in the divestment about, a transfer of most of the relevant IP to the U.S., or at the very least, the U.S. company is not, contracting with China for most of the algorithm, the IP. So the law is drafted to try to avoid that discretion and to make sure there is a genuine and real divestment. That said, I know a lot of corporate lawyers. There's a lot of creative corporate lawyerly out there, lawyerizing that goes on out there. And, you could think about scenarios where Trump tried to, make it relatively easier for ByteDance to have some relationship there going forward. But he can't just simply wish the law away. It is drafted so that you can't simply wish it away.
All right. Hey, finally, Peter, you mentioned that you thought the risks around foreign ownership were real. Were there instances or experiences that you had on the council that sort of informed that view?
So look, I think the security officials who have looked at this really see two major risks with TikTok. The first is a data security risk. This is an app that is collecting your location, it's collecting your social graph, and there's a risk that data is going over to China and could be used for espionage. The other big one, which I think we've seen just some recent research, public research about, is that the algorithm could be manipulated in order to surface propaganda or other kind of pro-Chinese content in a time of conflict. And I think that's a really hard one to mitigate. You can picture ways to mitigate data security risk with localization and that kind of thing, but the propaganda risk is real.
Peter, interesting discussion as we work our way up to the 19th. Appreciate the insight. Thank you. Peter Harrell.
Pleasure to be with you. Thank you.
Interesting to note, Meta shares have not yet benefited from the possibility that TikTok is going away. We've also got some news on Meta, and for that, we'll get over to Julia Borston. Julia.
David, Meta is planning to cut 5% of its lowest performing employees in its latest round of job cuts. Bloomberg was the first to report this news, citing an internal memo. We have confirmed this news with Meta. CEO Mark Zuckerberg saying in the memo that they typically manage out people who aren't meeting expectations over the course of the year. Now they're doing more extensive performance-based cuts during this cycle, saying the company expects to reach 10% of what they're calling non-regrettable attrition by the end of the current performance cycle, which includes roughly 5% non-regrettable attrition from last year, from 2024. So this is looking for effectively 10% of job cuts at the company, and Zuckerberg saying that the company will provide generous severance. The stock is now down about 2.5%. It was trading lower before this news came out. Back over to you.
Julia, appreciate that. As we are close to session lows, S&P up about 10. Let's get back to Sarah, meantime, at the NRF Big Show. Sarah?
Hi, Carl. In just a few minutes, we'll talk to Shopify here at the Big Show, but also wanted to tell you about more updates in the saga of U.S. Steel, Nippon Steel merger. So Lorenzo Goncalves, the chairman and CEO of Cleveland-Cliffs, not holding back at a press conference he gave yesterday in Pennsylvania, celebrating the 5-year anniversary of their acquisition of AK Steel, but really focusing on the ongoing feud with Japan's Nippon Steel and U.S. Steel being against that merger. Take a listen.
China is bad. China is evil. China is horrible. But Japan is worse. Japan is a lot worse. Japan taught China how to dump, how to have overcapacity, how to overproduce.
Spokesperson for U.S. Steel saying, quote, Lorenzo Goncalves' press conference remarks are another attempt to shift attention away from the illegal monopolistic conspiracies he has engaged in, all in the face of declining performance at Cleveland-Cliffs. So they're really, gloves are coming off here. U.S. Steel continues, we are incredibly disappointed in the verbal attacks levied by Mr. Goncalves toward the outstanding local leadership across Pennsylvania, the many members of the USW who have supported the combination of U.S. Steel and Nippon Steel, and the people of Japan, a critical U.S. ally. So, David, I know that Mr. Goncalves and Cleveland-Cliffs still believes in this sort of U.S. solution for ownership of U.S. Steel, and it's still going to be a fight. I would just add, on the Japan stuff, which is really what it's about, whether there's a national security risk, whether they're really a trusted partner here. I would note, and I'm not sure this gets a lot of attention, about a month ago, Nippon Steel was found by the Commerce Department on an anti-dumping case and was levied a price for that. So this still goes on right now, and I think that if you're a Cleveland Cliffs trying to make the case that there is a national security concern there, you would point to examples like this that are still happening.
Yeah, and he has been for some time. Obviously, as you know, Sarah, yesterday I reported Cleveland Cliffs has partnered with Nucor on a bid that will sit there for some time because, of course, the termination date for the deal under the rejection by President Biden under CFIUS has now been pushed back to June 18th. In fact, the same date that the merger agreement between Nippon Steel and U.S. Steel expires. So there's no need for Cleveland Cliffs to come forward with said bid. But as we made clear yesterday, they do have, in fact, that agreement with Nucor under which Nucor would buy Big River. And they would offer something, as I reported, in the high, let's call it 30s. Stock is up and was up yesterday on that as well. All right, we got a lot more live market coverage for you. Sarah's got more from the NRF as well. Don't go anywhere.
Insurance.
Make money.
Okay, Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the battle between rates and stocks, what it means for where the markets might go from here. Some interesting price action this hour. We will discuss all of it, of course, with the Investment Committee today. Joining me for the hour, Josh Brown. Stephanie Link is here, along with Jason Snipe and Jim Lebenthal. We'll take you to the markets. What was an early green picture has now turned red, and it's turned red across the board. There's the Dow, the S&P, NASDAQ, all under a little bit of pressure here. Rates took a little bit of a downward turn on that better than expected PPI report, but you take a look at the 10 and the 30 year, and yields were actually higher a moment ago. So we're watching all of that. And Steph, therein lies the issue for the stock market. You had a little bit of a cooler read on inflation, but rates barely budged. And it's because we're still kind of assessing what Trump 2.0 policies are going to mean, and if they're going to be more inflationary or not, and what the market's going to do as a result.
Yeah, the unknowns, certainly. There are a lot of unknowns, but remember the Trump administration 1.0, the inflation number was 1.9% under his administration. So he does not want inflation. And I don't think that tariffs are going to lead to inflation, especially if they kind of phase them in. I don't think they're going to be as bad. I think it's going to be more than offset by the pro-growth policies, lower taxes, less regulation, that sort of thing. And he's also inheriting a strong economy. The economy is growing 2.5%, 3%. And so you asked the question yesterday to Rick Reeder, can stocks go up if rates are going up?
Yeah.
I think they can. I don't think they can go up 20%. Well, but I think they can. And I think they can if rates are going higher because of better growth, which I just mentioned, and stickier inflation. But you know what? The peak PPI number 2 years ago, 11.6%. We're now at 3.3. We're making progress. And the reason we're seeing inflation higher is because growth is higher. I, as an investor, all three of us, four of us with Josh on the line too, we would much prefer better growth and a little bit more inflation from the earnings side of things. And that's what we care about as investors.
Rick Reeder, since you bring him up, you know, we talked about the fact, and he firmly believes this, that rates are going up for the right reason. Yeah. It doesn't mean the stock market's not going to have volatility associated with it. But now that you brought it up, Steph, let's listen to what BlackRock's Rick Reeder told me yesterday on Closing Bell about what he thinks can happen in this market.
We're still moderately long. And I still think if you look at tech and the return on equity, the stock buyback, and the amount of cash that's out there, pretty hard to see the equity market not finding its footing and having a decent year, not like last year.
All right, decent year, not like last year. So we're not going to do 20%, Jay, but he said you can do 15.
Yeah.
Right? You can still do mid double digits, which I think everybody in this viewing audience would accept.
Right. And I would agree with that, Scott. And I think when I look back to the NFP report last week, which obviously was an explosive number, the number I paid most attention to was unit labor costs, which are back to pre-pandemic levels. And for me, what that spells is productivity, which then leads to margin expansion. Earnings start in earnest tomorrow. Right, so we'll hear from the banks, and then we'll continue to hear from a lot of other companies. And I think it'll be a margin expansion story. Obviously, there's a higher hurdle to jump over, 14% earnings growth for 2025. But I think with what margins can do, I think we'll be able to jump over that hurdle.
So, Jimmy, Tony Pasquarello, Goldman Sachs, I cite his research all the time and his notes, which go out to, very well-connected clients and large clients, hedge funds, et cetera. He passes a note along just before we came on the air today, which he says, quote, the character of this trading environment has changed and the distribution of potential outcomes has seemingly widened. What I mean here, market participants are actively debating the sequence and impulse of Trump 2.0 policies, as well as the attendant path of monetary policy. And with all that comes some friction in markets that manifests in risk reduction. How does that playbook change? Well, it's still a bull market, he says. Primary trend is higher, he thinks. But I suspect that moderately higher volatility is here to stay for a bit. Would you agree with that assessment of where we are, along with Reeder's perspective that, quote, it's pretty hard to see the equity market not finding its footing and having a decent year?
I would agree with what he says. I think he throws his punch a little softly when he says we're still in a bull market. I'll try to say it a little bit more strongly. The economy is very strong right now. We've been clocking 3% real GDP growth for several quarters. That's fabulous. We've got unemployment at 4.1%. Again, another fabulous number. The Fed, look, they're not talking about raising rates, and they won't unless inflation starts to pick up. We're talking about the rate at which inflation is coming down and the impact that that's having on interest rates. Now, Scott, you've brought up the Trump policies. We can't answer the question right now of what the impact of those policies are going to be. We need to see the policies. We need to see what their intent is. But we have to remember that backdrop of a strong economy. What we've gone through in the last month is not even a correction, even though several of us have been thinking that a correction is overdue. This speaks to Mr. Pasquarello's comment about higher volatility. We've had an adjustment. We've had an adjustment to higher interest rates in the equity market, which has happened several times in the last 3 years since the Fed started to make interest rates relevant again. And I will point out that it bears perspective. It was about 6 months ago that the Fed passed on cutting rates in July, and the market freaked out. Remember people talking, Scott, you remember this, right? Talking about, hey, we need an emergency rate cut because we got some tiny uptick in unemployment. Let's have a little perspective here. We didn't need emergency rate cuts then. We don't need emergency rate cuts now. Frankly, we don't need a rate cut this month. The economy is awfully strong. And to Steph's point about profits, that should eventually follow what the economy is doing.
Readers suggested you may just get one this year. And
That's
you're not
fine.
going to get one for a while
Yeah.
either. And that, you know what? That's okay. And Josh, you know, where Pasquarello suggests that the character of this trading environment has changed, I guess it's and the outcomes are you know more wide than they were, because essentially what was relatively easy in quotes over the last year is just going to be a little more difficult as we assess these new policies, as we assess whether they're inflationary or not on top of what is already a still elevated inflation situation. You're not back at target fully, so we still have to keep that in mind as we assess what you think we can do in the face of all of that.
Yeah, I read Tony's stuff as well, and I think the key phrase that you just repeated is the trading environment. And I think one of the more important things to talk about when we talk about the trading environment is whether or not that's necessarily relevant to all of the people who are watching this. At my firm, one of the things we do on the wealth management side is run an in-house tactical model. And there are no interest rate or inflation inputs in that tactical model. Last year, it was 100% invested 100% of the time. There were no tactical sells of equities. And we got questions, Scott. Well, what about the 10-year? Or what about inflation readings? And we leave that entirely out of that decision-making process on the tactical side. And thank God we did, because it's just so noisy. But when you pull the lens back, and we do this for clients all the time, what you realize is that there is no set in stone negative correlation between the returns for the stock market and whether or not the 10-year is going up or down, or the absolute level. From 1950 through the end of the pandemic era, when the S&P 500 with a 10-year yield up 1% or more had an annualized return of just shy of 11%. If that number sounds familiar, that's the same as at all times, meaning it really doesn't end up being a factor. And when you think about a 4 to 6% 10-year yield, which is where we are today on the 10-year, in 55% of all 3-year periods, the S&P is higher. It's a coin flip. But in 100% of all 5-year periods, it's up, which should tell you this is normal. The median 10-year Treasury yield, the median is 4.6. The average is 5.2%. This is what it's supposed to look like. And I think you have to decide, am I trying to trade the next rate decision, or do I want to actually accomplish something with my longer-term investments? We make that decision with people. Others might choose to react to this or that PPI number. It's just not what we do.
I mean, you know, Steph, Bank of America, as they track their flows and what their, you know, equity clients are doing, you've had the 10th straight week of buying. Net buyers for the 10th straight week. Private clients' biggest purchases were in healthcare, a big lagging sector of a year ago. as we all know, right, healthcare has lagged. I know it's not as sexy to talk about as the mega caps and some of the other high-flying sectors in this market, but nonetheless, it's where a lot of action is, including from you.
Yeah.
Because you bought United Health. Tell me about that.
Yeah, I've owned it in the past, but I haven't in the past year and a half. It's always been, it's always sold at a premium to the group, and it should. It's the #1 managed care company in the industry, and they have a gem with Optum. And they have been doing lots of M&A to build up Optum, which is 24% of their total revenues, and they're going to do 12% operating profit just in this one segment alone. And the stock is now has not really done anything in the past year, and it is the whole sector, as you mentioned, is so out of favor. I kind of like that as a contrarian. And what got me interested is it's trading at 17 times earnings, and historically the stock has traded at 21 times forward. And when I owned it, it was trading at something like 25 times because every quarter was a beat, a raise, a beat, a raise. Now, I don't expect the quarter to be great tomorrow. In fact, I think they're probably going to miss on medical loss ratio because utilization rates are so strong, so high, and that hurts their costs. But I do think it's temporary. I think they're going to be able to handle it. They're going to see double-digit growth in earnings and revenues, and they have an $18 billion buyback program. So you get #1 company on sale. I think that the company, the visibility going after this quarter gets better and better. And by the way, I think the PBM regulation and the concerns there, yep. I think we've had 26 different kinds of regulations in the last 2 years out of Congress, and nothing has gotten done. So I think it's noise.
So I always find it difficult to talk about this stock without acknowledging what happened with the United Healthcare CEO. And right. Then the subsequent anger that bubbled over the top from the surface to the surface, obviously, about these businesses. And I just wonder if what has been judged to be at times from several of you on this desk who own the stock or bought it after that event, if this is not so much a this too shall pass sort of an event, and if it's enough of a changing event that this stock is going to be under scrutiny as the industry itself is for a longer period of time than some would like to believe. I don't know how else to really say it.
You framed it well.
I feel as though we need to address it anytime somebody buys this stock, especially as a new position, because I feel like the environment around this whole thing has changed.
You have framed the question well. You've done it delicately, as befits what happened last month. I think there's an important piece of news last week, and there was yesterday, and there was a lot going on yesterday. I'm not sure we covered this, but United Health and others like CVS and Humana were up big yesterday because Medicare came out with some projected reimbursement rates that were much larger than expected. And while the debate that you framed, Scott, is not going to be answered today, tomorrow in earnings, it's going to be answered over time. I think there's a pretty big clue that yesterday's news, which comes well after the debate has been framed for a month, and we got better reimbursement for the government. I think it's a tell. I think it's a tell that the government realizes that in order to administer Medicare, they need United Health and CVS and Humana and others. They need these companies to administer Medicare. Look, the debate will continue, but I think
because
that's a pretty
you
good
own the
sign.
stock and you've added to it.
Yep.
In recent weeks too, you own the stock as well.
You got it.
Decent buy right here. In light of everything that we're discussing?
What Jim just said, which is, I think, paramount, because Medicare and Medicaid funding is always on the docket for this stock. That news yesterday was huge in terms of the reimbursement rates. Utilization is as well, that Steph mentioned. But for me, this has always been an earnings compounder. They're talking about 13 to 16% EPS growth over the next 5 years. And Optum is a juggernaut. So I continue to like this stock. The big thing, too, Steph, and I applaud the buy, is they guided conservatively in 2025. Yeah. So there is definitely room for upside surprises.
To your point, though, Scott, this is one of the reasons why the stock is trading at the multiple that it is. It's derated, and we don't have answers to it.
Well, you could see it from if you bring the chart out wide again, and you will see what was a $650 stock or 30, whatever it was, has in fact re-rated, and you can see You can broaden it out further than that, please, to get a picture of a stock that had run up, and you can see the decline in it a little bit more. There you go, more
But that's
clearly,
exactly
obviously.
why I bought it, right? Because it's down so much, and a premier company. I know it's not perfect, but a premier company, number one, with a number one management team, they'll get through this, and I think the multiple over time will go back to where it historically has been. And I mentioned 17 times versus 21 times for the average. It's also trading at 12 times EBITDA versus 15 times for the average. So any metric that you look at, along with the stock price coming down, I think it is a buying opportunity, as delicately as I can say that, right? I mean, I know it's messy, but when you can get number one on sale because of something is messy, I think the management has proven that they will re-engineer and get back to double-digit earnings growth and revenue.
You have a new buy in the space too, Jim, and it's AstraZeneca. Why'd you take a position in this stock?
Number one, I wanted to get bigger in healthcare. We know that healthcare had a terrible year last year, and that's what usually happens in an election year. So I start from the point of view of I want to get bigger in healthcare. I do like the pharma space. There tends to be very nice dividend yields. These are a cheap valuation, but there's something specific about AstraZeneca. They were refilling its pipeline over the last couple of years, and it was starting to get some respect for that until the late summer, early fall, when there was a lot of news coming out of China about investigations into AstraZeneca's business in China. That knocked the stock down from the high 80s to the low 60s. It's now in the mid 60s where I'm picking it up. I think that knockdown, look, there's a knockdown in United Health for a totally different reason. Steph's buying into it. I look at that knockdown and I see it as an attractive entry point to a very good franchise that has a diverse pipeline and a diverse business beyond just oncology. It's got cardiovascular, it's got rare disease, and the China business gives me the opening.
All right, we have some movement too, not necessarily new buys or sells, but we have additions in terms of Josh Brown's best stocks in the market list. So we have some additions here and a few subtractions too, Josh, that I want to address because we've been highlighting these for our viewers, and we do have some ownership around the desk. So in to the list, the best stocks in the market is 3M, Becton Dickinson, and EOG. You want to talk about those first, please?
Yeah, so let's start with EOG because this one has not broken out yet. This is a stock that's been consolidating at give or take roughly the same level going back to early 2022. It's at the higher end of the range. It just popped onto the list. And I think this is the type of situation where you can anticipate the breakout. I think if you're a trader, you sort of want to play this with a stop. What I would do here is utilize the high 1-teens, like 118, 119, as my downside protection. If this were to break down, that's where you want to be out of the name. But if this stock can break above 135, there's really not a lot of resistance here. You have to go back a couple of years to find sellers at that level. And it's in a sector that's starting to reawaken after just horrendous relative performance to the rest of the market. The other one we should do is 3M, which I personally own. I've been in the stock for a while. This has been the type of situation where it had a huge breakout. Stephanie's in it way earlier than I am, but I'm still there. It's been consolidating since September, and now I think it's ready to take its next big leg up. It's right at the upper end of that range, within 1% or 2% of 52-week high. And RSI is fairly cool, which means it's not overbought and it hasn't made its move yet. So these are two names that I think, both for traders and investors, belong on their radars.
Okay. The other you didn't do. Well, you want to comment on 3M, Steph, real quick,
Yeah,
before we do the Becton?
Yeah, I mean, the new CEO, he's in the job for like a minute, and he has a great track record. Operating margins are the story in the short term. Eventually, they have new product growth, about 10% growth. That should help 2025 as well. But watch the margins, because I think that's what's going to drive the short term positively.
Okay. So give me something on Becton Dickinson. What about it makes it worthy of this list?
This is another long-term consolidation, sort of trading relatively near the older highs. Again, this is medical and surgical products, so it's in a sector that, just to Jim's point, was absolutely left for dead. Nobody wants to be in these names while there's potential for negative rhetoric on campaigns across the country. But that moment passes, and these names get rediscovered. So it's a modest dividend payer. It's a $67 billion market cap. It's in an area that people haven't been focused on. But again, it's been trending higher. If you take a look at the way this stock has performed since December, you could tell the tax law selling here. People that just wanted to walk the books by year end in a year that clearly need to offset. That probably peaked the first or second week of December, and ever since, it's been like a beach ball you've been trying to hold underwater, and it's just been kind of levitating higher. I don't think there's anyone left here to sell. A breakout above 225 would be really interesting for a short-term trade.
So in terms of leaving the list, I mean, there was an event around Constellation Energy, so I get it. The airlines, United and Delta, have had amazing runs, so I get it. What about Arista Networks?
Look, this is a pure momentum name. It's obviously highly caught up in the AI story. A lot of the people who, quote unquote, missed NVIDIA grabbed onto this thing as kind of a life preserver amongst growth mutual funds who didn't want to buy a stock that was up 500%. I understand that mentality and I understand that instinct, and it worked. This has been one of the better performers over the last year. I just think whenever you have a name with a beta like this, that is so much more volatile than the overall market, and you have a hiccup in the market, this is exactly where you're going to see selling, and that's all that happened here. I think the longer-term trend is intact, and I wouldn't be surprised if this stock, if we get a healthy tech market, doesn't get back up toward the highs of a week and a half ago. So I wouldn't be despondent over it exiting the list, but it definitely needed to cool off, and that's what happened over the last couple of days.
Jason, you own the stock, right?
Totally agree with what Josh is saying. The stock was up 80% last year. It's the number one cloud network solution, switchboard provider. So for me, the momentum is broken. It will come back. There's so much CapEx spend in the AI and cloud space. So maybe it's taking a little bit of break, a little bit of digestion, but this will be a long-term term for us.
Okay. Jimmy, I want to get to a quick move of yours as well. We barely have referenced mega cap tech, and Apple's been about 10% off of its high, its most recent high. You're trimming the stock, which I find interesting considering, as I said, you're trimming it when it's already down almost 10%. Why?
Well, of course, it's had, a great run here. I think we'll all acknowledge that. So starting from the point of view of it's a sector rotation, I was buying into healthcare. We talked about that earlier. I'm going to trim the technology sector, which I think we'll all admit has had a fabulous run. There's a little bit of another level down when you look at the Mag 7, which, of course, Apple is a core member of. I'm trying to say with my moves that I am picking spots within the Mag 7 that I want to accentuate. Those include Amazon and Google. They are I am de-emphasizing Microsoft and Apple by the trims that I've done. Now to a more specific comment on Apple, I think all the news that's coming out on the name is showing that the much hoped for super cycle upgrade just isn't happening, at least anytime soon. And I don't think that's fully priced into the stock.
So, Jason Snipe, how are we feeling right here about mega cap? Which had really resumed its leadership role, which made some people uneasy that it was a top-heavy market again. Right. But we've had a rollover. As rates have gone up, a lot of these mega-cap names have come down. Temporary? What do you think?
I do think it's temporary, and I think obviously they don't trade as a monolith. That's absolutely clear. I like the play. I like what Jimmy just mentioned. The names that we also like in this space are Amazon and Google. Amazon, for me, their operating leverage continues to grow. I think retail is back. They have kind of brought back those pre-pandemic gains that they had. When I look at AWS, as a as one of the number one players in the cloud space. I mean, their margins were the largest margins growth since 2015. So I think there's momentum there. When I think about Google, I mean, they hit on all cylinders: retail, advertising, YouTube, all were strong, and cloud revenue. So I just think, the Lina Khan story, the DOJ, that will probably go into the background as this new Trump administration comes into play. So those are the names that I continue to like, and I think there will be continued growth there.
All right. We'll take a quick break. We'll come back with a double dose of deal news, moving two of Jim's names today. We'll document those trades, and later a Josh Brown hot take, this time on housing. We will discuss coming up. All right, committee stocks on the move today. Pfizer, JP Morgan Securities says Pfizer to sell 700 million ordinary shares in the British healthcare group Haleon. Also, the CEO, Josh, downplaying that dispute with Starboard Value, says it has support, in fact, of major shareholders. You own the stock. What's the read here on this?
He could downplay it all he wants. If this stock is still in the 20s 2 quarters from now, I think he's gone. This is a company that chose to speak at the biggest healthcare conference in the country and spend most of the time talking about cost cutting. This is in the context of a world where we are literally transforming the shape of obese people's bodies and performing miracles with robotic surgery, et cetera, et cetera. You can't run a company of this size and have as uninspiring of a pipeline as they have for very much longer. The good news is they're doubling down on oncology. They still think they're in the weight loss drug chase. The bad news is nobody believes them. Look at the share price. That's your, Mr. Borla, that's your scoreboard. So that's what you need to focus on now. What is it going to take to move that higher? $4 billion in cost cutting, $60 billion in revenue is not doing the trick. Nobody's excited.
I mean, this was a stock that was once on the best stocks in the market list, too, but had since been removed. SLB, let's talk about that, Steph. Under pressure, apparently, or reportedly, I should say, better say, from lawmakers to withdraw from Russia amid new sanctions there.
Russia is about 5% of their business, and they've actually talked about that coming down over the next couple of years. Maybe not zero, but maybe like 1%. So whether they exit now or they just let it drain out, I don't really care. I care that this is the number one oil field services company, trading at 11 times earnings, returning $7 billion in cash to shareholders last year, this year, next year. All they do is beat and raise. They're very, very good in terms of execution. Technology is underappreciated. So down 25% in the past year. I think at 11 times it's a buy.
All right, Cleveland Cliffs. This has been an interesting and still developing story. The CEO, your buddy, attacking Japan as he reiterates interest in acquiring U.S. steel, may partner with Nucor in a potential bid. Now, I want your take on that because you, if I recall correctly, at one point said you didn't want them to do this deal because you're worried about the price that they were going to pay.
It's not now it's not the price that we're going to pay because the original or the last offer they made was 54, and now we're talking about something in the mid 30s. But the balance sheet, only has so much room. Lorenzo Gonzalez and the team there certainly knows that. They don't need me to tell them that. As an investor, the reason that I would like to just get U.S. Steel behind us is because Lorenzo and team have just bought in November Stelco, and they bought it as the steel price cycle was bottoming. It looks like steel prices should go up in the new Trump administration. And I'd rather just see the execution of the new acquisition bring the share price higher. Now, all that said, Lorenzo and team are going to do what they want to do, not what Jimmy wants to do. If they end up buying pieces of U.S. Steel, and I think it's pieces in conjunction with Nucor, I don't think they're going to buy the whole thing, that will obviously make them bigger, but it will bring balance sheet stress. That's just the way it goes. I'll close this by simply pointing out that Lorenzo himself bought $1 million worth of shares in May of last year. He bought it at $14. He's not dumb. He didn't make that purchase thinking that the stock would be down at $10. It's going to be dramatic. It's going to be volatile. I think from here to year end, you're going to see positive returns on the stock.
You want to give me something on Wabtec's deal, Evidence Inspection Technologies division for a $1.175 billion?
Yeah, Wabtec couldn't be any more in the sweet spot where I want to be in this market, which is to say industrials. You've heard me say for quite some time, industrials are going to benefit from supply chain onshoring, infrastructure. That is certainly going to continue in the new Trump administration. For Wabtec to get bigger doing that makes sense to me. This is the quintessential industrial. It's where I want to be.
All right, let's get the headlines now with Pippa Stevens. Hi, Pippa.
Hey, Scott. President-elect Trump said today that he will create a new department to collect tariffs, duties, and all revenue from foreign sources. In a social media post, Trump said the External Revenue Service will be created the day he is inaugurated. Trump has pledged to impose steep tariffs on the country's three largest trading partners, China, Canada, and Mexico. NATO will launch a patrol and surveillance operation to help protect critical infrastructure in the Baltic Sea. At a news conference in Helsinki, NATO Secretary General Mark Rutte said it would work to deter future acts of destabilization. The operation comes in response to a string of recent incidents of suspected sabotage on undersea cables. And Kate, the Princess of Wales, said today that she is in remission from cancer. The princess's announcement on social media comes as she visited the hospital where she was treated for cancer and thanked the medical teams who treated her. The princess announced back in September that she had completed chemotherapy treatment. Scott, back to you.
Pippa, thank you. That's Pippa Stevens. Straight ahead, Josh Brown's hot take on housing, why he is so fired up over this space today. We will explain next.
you